I think right now we have to recognize, at least in the U.S., the S&P 500, above 2075, 2100 area, it's really a pain trade area. It's an area where fundamentals really don't make sense. Valuations are stretched, and it doesn't take much for the market to go from being very comfortable to being very cramped. I don't think the numbers that we just saw are going to do anything to encourage or discourage the Fed. I do think they're on track probably for a July rate hike, barring any kind of disaster outcome in Brexit, et cetera. But I don't think it's going to play into it because overall the inflation story is good.
Just on the Fed, I mean, if we do see them hiking in July, as you suggest, I suppose the question then becomes what happens after the next hike. I mean, do they wait another 6 months or do they hike more rapidly after that? And if that is the case, I mean, if we see them hiking more rapidly, say another couple of rate increases this year, what is that going to be doing to the US dollar? That seems to be the big question.
Yeah, that is a big question. And you think now that the market has gotten comfortable with the fact that the Fed might or will raise rates, you'd think the dollar would start to catapult like it did last time, but perhaps not. Maybe there's other things going on beneath the surface that we're not seeing. So I do believe that we're going to raise two more times this year, July, and probably not again until December. If they raise before December, it's only to catch up with inflation. That would ultimately be a headwind, a bad thing, trying to catch inflation in the act, and not very good for the markets. But I think generally speaking, the growth story is not great. It's comforting, but it's not comfortable, as it were. And I do believe December and July both make sense.
And how do you think the market might react? Because, I mean, the Fed's messaging seems to be to the world that, you know, we are doing better than you all think. And markets very much seem to be warming to that view. How do you think the market will respond if we do, in fact, see a rate rise in June or July?
Yeah, just a few weeks ago, I was thinking and saying that I thought the market consensus was asleep and in denial about the whole thing. But I've come full circle and realized that, you know, we didn't get up to 2,100 in the S&P 500 because of the great earnings season or because of great numbers. I think it's a pain trade that people are looking to next year, thinking $130 a share is a good number. And the fact that the Fed is raising rates is a good thing, something that we've been talking about for months, if not years. So we're not near escape velocity, but the fact that the Fed is raising rates doesn't have to be a headwind. And that's why I think the market rallied like it did.
Well, speaking of the market rallying, I mean, the S&P over the month of May, it had a pretty solid performance, up for the third consecutive month. It was up about 1.5%, although still flirting with that 2,100 level. Given, though, that valuations and multiples are looking a little bit stretched, Larry, do you think that there is still room for more upside with the S&P?
Yeah, I absolutely do. I mean, I think the value may be elsewhere. I still believe Japan and Europe fully hedged make more sense right now. But up here at $130, that's what people are assuming for 2017. That makes a lot of assumptions. It assumes that the Fed's rate hikes will go smoothly. It assumes that Japan won't do something like they did in January again. It assumes China, their currency not devaluing more than it already has. So it's a stretched market, but that doesn't mean you can't make money. And a lot of times the markets that you're afraid of are the ones you should be invested in.
All right. Investors obviously now going to be monitoring that non-farm payrolls data, which is due out on Friday. What is the target band that we're really hoping to see that really should keep the Fed on track for potentially a June or July rate hike?
Yeah, it looks like it's going to be a really boring repeat of last month. 160,000 ads, 5% unemployment rate, 2.5% wage growth, exactly precisely like last month. What's interesting is that consensus is willing to lower the ads per month. Remember, a year ago, it had to be closer to 200,000 to be a good number. And at this point, 160,000 is more than reasonable. So, I mean, unless the number comes out at below 100 or above 250, but I'm thinking around 150, 160 area, we should be okay.
Okay. Away from the economic data, we also have a little bit else in terms of broader macro issues on the agenda this week. First and foremost, the ECB, it's meeting on Thursday. Is this likely to be a sort of relatively uneventful event?
Yes. Yeah, no, it seems like that's going to be a sleeper. Nobody, I mean, you look at volatilities, implied volatilities in the currency market, they have not moved as we've gotten closer to this date. So I don't think anybody's expecting anything at all.
Okay, and what about OPEC? Because they're also meeting on Thursday.
Yeah.
There very much talks of a freeze deal of been fading and so forth. What are you expecting to come out of OPEC?
You know, it's too bad. I think it's going to be a big nothing. I mean, well, they're not going to be talking about freezing anymore with oil up around $50 a barrel. So I think it's going to be just like the last meeting. And remember, in January, everybody was looking forward to this meeting in June. And it's going to be a big brouhaha. We're up at $50 a barrel oil. It doesn't seem like there's a whole lot to talk about right now. I think the biggest thing to talk about is a small number coming out tomorrow, the U.S. ISM number. Just keep in mind, a lot of our survey numbers before that have come out really soft. Philly Fed, Richmond Fed, the flash PMIs. That's a really important number to pay attention to. Also, China PMI, which comes out in a few hours.
Yeah, exactly right. Well, what are we expecting there? Because, I mean, numbers recently have been pretty soft across the board coming out of China. So for us today, it's going to be really a key focus and a driver, no doubt, for our Aussie dollar as well. So what are the expectations for those PMI numbers?
Yeah, I think the expectations is like as steady as she goes from last month. But the fact is all the preliminary data, which we know isn't as robust, isn't as reliable, has come out pretty soft. So people are worried that are we going to go into contractor mode? And if that's the case, then this could be a really hard time for the market over the next few days.
Yeah, okay. I think you did sort of allude to a couple of the factors ahead, but what are some of the big outstanding macro issues that we need a little bit more clarity on? I mean, we do talk about a number of these upcoming events and central banks and so forth in focus. What are some of those macro issues that we need more clarity on that will no doubt be needed, I suppose, to move this market higher?
Yeah, there's a lot of them. We have Japan. Like, recall the policy that caught everybody off guard with the negative interest rate policy. Can they can't afford to make that type of mistake again. It really would be upsetting to the markets. You have that extreme. You have China, which I think is a really good multi-generation story. But here and now, the currency is a little bit weak, and we have some deleveraging going on in emerging markets. But we can't count out the U.S. elections. I mean, I used to never think that mattered, but right now, it seems like the Senate race is up for grabs. I think the Republicans will still keep the House, and Clinton seems to have a slight edge in the election. So it's going to be very interesting between now and fall.